Hello there, everybody. This is Pablo from Masters in Trading. In front of you, I have the Equities Edge series chart with just the Nasdaq and the S&P futures plotted. I decided to go back in time. I told my Thinkorswim to show me in daily aggregation all of the data that it has. And I did this by doing 1 day max. And the nice thing about these two contracts is that they have some history. So I went back to the year 2000 when the whole dotcom bubble happened. I went back to 2008, when that whole thing happened. And I'm comparing them to what's going on right now. So let's do some numbers, okay? Currently, the Nasdaq futures are implying a 63,000, now 62,000, 63,000 implied move, implied range, and that is based on the implied volatility, which on the Energy Edge series of all the tools, you will see it right here, and right here, right here, and right here. So the implied volatilities are used to compute these in real time, live. Okay, so right now, if we plot this, put this price line right here. Oh, what's going on? Just want a price level. Okay, 63,000. I'm going to activate this, hit my space bar to copy it, put another one down here. All right, 62, that's good enough. Right click, extend to the left. Right click, extend to the left. Here's 2008. Look at where our lines are, guys. What's going on right now makes 2008 look like a little blip. Now, let's go to the dot-com bubble, the year 2000. That one just so happens to be at exactly the same level of implied range. Keep in mind, though, that back then, in the year 2000, the Nasdaq product and the S&P 500 product, they were not, by any means, the same price that the current Nasdaq and the current S&P are, right? Just a few days ago, this was a $9,000 product. This was a $3,300 product, and then the Dow was almost almost $30,000 product. So the range takes implied volatility and price into account. Back in the year 2000, implied volatility must have been way higher than 36% on the Nasdaq. In order for the range to have been 63,000 back in the year 2000, and Nasdaq was nowhere near close those levels of 9,000 and whatever. That means that volatility right now is low and could potentially go much higher. So just keep this in mind. Look at all this data. Here's 2008, guys. Here's the crash, the great financial crisis. Okay, look at the implied ranges back then, and look at where we're at right now. Okay, that's a whole order of magnitude different. The distance from there to here is $33,000. So the implied ranges that we have on today for price action today are $33,000 higher, more volatile than they were during the worst of the worst of the worst of the year 2008. Be careful, folks. Be careful. Equities Edge, Masters in Trading. This is Pablo. I hope this has been informative.